Stocks, bonds, real estate, mutual funds, exchange-traded funds. There are countless assets that you can invest in. And in this video, I'm going to show you the most important assets that there are on financial markets. And we're going to look at two investors, David Swensen and Nikolai Tangen. You might not know the latter, but he's actually the richest investor in the world. And I'm going to show you exactly what he's investing in. So let's get into it. So assets can be broadly split in two categories, productive and non-productive assets. Productive assets are simply assets that generate future cash flows. So stuff like stocks, bonds, or real estate. If you buy stocks, you get dividends. If you buy bonds, you get the repayment. And if you buy real estate, you get your rent. In other words, people buy those assets because they get returns in the future. Non-productive assets, on the other hand, are assets which do not generate future cash flows. Examples would be natural resources like gold, currencies like US dollar or euros, or financial derivatives. So derivatives are actually very complex financial products. To boil it down, a derivative is an asset which is a function of a different asset. So to put that in math, we apply a function to some kind of asset, like for instance, the Apple stock. And this function, it can be anything. And believe me, financial people have been very creative. So for instance, one derivative could be you always pay the square of the dividend of the Apple stock. Or you pay the dividend of the Apple stock plus 5. Or you pay the square root of the value of the Apple stock in a year. So derivatives are very general. It's just a function applied to some kind of asset. But because we're in a basic course here, that's all I want to say on derivatives. You might now wonder, if non-productive assets do not pay future cash flows, why do people hold them? And people hold them to mitigate risk. Let me give you an example. Let's say you're a German car manufacturer and you get your tires for your car from the US. In other words, every single time you buy tires, you buy those tires in dollars. And because all your revenues are in euros, you're exposed to the euro-dollar exchange rate. So for example, we have year one, and your tires always cost $100. And in year one, the exchange rate is 1-to-1, so your cost in euros is minus 100 euros. In year two, you still pay $100, but the exchange rate has changed. The dollar is way stronger now, so in euros, you pay minus 120 euros. And let's say in year three, you still pay the $100 for your tires, but the dollar has become weaker, so you only pay 80 euros. So what do you see? There's immense volatility in terms of euros. And because you're a German company, you report your revenues in euros and you report your company value in euros. So in euros, it looks like you're an extremely volatile company. And that's bad for multiple reasons. First, investors just do not like volatile companies. You look like an idiot if your revenues change the entire time. And second, this can just be risky. Let's say you have a great investment opportunity. You want to issue stocks, but now this is a year where the dollar is extremely strong. So you have a lot of costs in euros and your company value is very low. So you won't get a lot of money for your stocks. So in other words, you're exposed to risk because of this currency trade you have between euros and dollars. And here's what you could do. You could just, at the beginning of year one, buy $100 for 100 euros and have them lying around in cash. And here's what happens to the value of that cash position in the 3 years. So what happens in year one? Well, nothing. Your position in dollars is still worth 100 euros, so nothing happens. In year two, however, the dollar grows stronger. So your $100 are now worth 120 euros. So your position appreciates 20 euros in value compared to how you initially bought it. And in year three, now your $100 are worth 80 euros. So compared to the initial position, you lose 20 euros in value. And now look at what happens to your overall net position. In year one, you pay the 100 euros, so you have spendings of minus 100. In year two, you pay minus 120, but your dollar position appreciates in value, so your total net position is still minus 100. And in year three, you only pay 80 euros, but your dollar position lost in value, so you pay minus 80, minus 20, so minus 100 euros in value. So what do you see? Compared to your initial volatile cost, your costs now are flat. You have mitigated, or in finance say hedged, the currency risk, US dollar versus euros. And that is why people hold non-productive assets. They allow them to mitigate risk. And that is what non-productive assets are there for. So if someone tells you he or she is trading with currencies, you should be very skeptical. Going one step further, you now know what the most important assets are, but from the last videos we know you never want to invest in a single asset, but always in portfolios. And that is where funds come in. Quick review from the last video. We have our individual assets. So this could be one stock, this could be a government bond, this could be a currency, $100, and so on and so on. So what the fund now does is the fund now chooses some of those financial products, so some stocks, some bonds, depending on what kind of fund you are, and puts them into a single financial product, the fund. And now you as an investor can buy a share of that fund. And that makes everything a lot easier. Let's say you want to invest in the 500 largest companies in America. You don't need to do 500 transactions. You just look for the fund that has bought those 500 companies and you just make one transaction. You just buy from that particular fund. And there are a couple of different types of funds. Most famously, we have exchange traded funds or ETFs, mutual funds, and hedge funds. The biggest difference between exchange traded funds and mutual funds is that the price of exchange traded funds is updated every second and the price of mutual funds is only updated once per day. In other words, exchange traded funds are more transparent. If something happens, for instance 9/11, the value of exchange traded funds will react immediately. So if you hold an ETF, instantly after the airplanes crash the tower, you can look at your portfolio and the value of your funds will have changed. But mutual funds, their price only change once a day, at the end of the day. So with mutual funds, you would have to wait until the end of the day until you know how the value of your fund has reacted to a particular event. So the big difference is the transparency. ETFs change their price every second, mutual funds once per day. And hedge funds, they're kind of more advanced. There are not a lot of legal rules applied to hedge funds. For instance, mutual funds and ETFs, they can trade some financial derivatives. A hedge fund, pretty open to what they can trade. And for a hedge fund, it's also more exclusive. So for instance, you can most of the time only invest if you invest a minimum of $500,000 and you need to prove that you have some kind of financial knowledge or that you've studied finance in some kind of way. So a hedge fund is mostly targeted at very wealthy and very knowledgeable people who want to invest their money. To give you some examples, one of the most famous exchange traded funds is the iShares Core S&P 500. iShares, that's the company that offers the ETF, and S&P 500, that is what is in the fund. S&P 500 stands for the 500 largest companies which are listed in America. And here you actually see a list of those companies. You should probably know a lot of them. Why? Because I mean, they're large companies. They are part of our daily lives. Another very famous index is the iShares MSCI World. iShares, once again, the same company, and MSCI World, that's what's in the index. And the MSCI World tries to look at the 1,500 largest companies in the entire world. So here's the list. And once again, you see a lot of those companies are also in the S&P 500 because America has just the largest companies in the world, so they're in both indices. But in the MSCI World, you will also find companies which are not in the S&P 500 because it has a broader spectrum it's looking at. So now that you know what's out there, what people can invest in, let me show you how the best investors out there actually choose their assets. And first, I have a question for you. Who do you think is the single largest investor in the global stock market? Is it A, the Emirate of Qatar, B, Bank of America, C, the government of Norway, or D, Warren Buffett? The right answer is C. It's the government of Norway. Norway has made significant revenues from selling oil, and they've actually saved a lot of that money and put it into an investment fund. And this is the guy who manages that fund. Nikolai Tangen, he has a total of $1.3 trillion to invest. Last year, I actually heard a talk from him, and he started with this. You know, there are a lot of people who hold records. My record is, I'm the guy who lost the most money in a single year. Because during COVID, his investments, like everybody else's, crashed incredibly. But let's see how he specifically invests. So the government bank of Norway is called RICHEST Bank, and here's how they invest. It's about 70% equities, 30% bonds, and a very negligible amount of real estate. And this is one of the most common and basic allocations in the world. 70% stocks and 30% bonds. Let me show you what's actually inside of that 70% stocks. So this is their stocks by industry. And what do you see? It's a pretty equal distribution, right? It's 13% in consumer discretionary, it's 16% in financials, it's 13% in healthcare, it's 18% in technology. This is very balanced out. And you know why? It's to create the maximum diversification effect that I explained to you in the last video. So this is the most basic, plain vanilla way you can invest, and you see the richest investor in the world actually follows that to the T. So this guy's actually very boring, but he's been pretty successful. During the last 20 years, he has had an average net return of 5.7%. But let's now turn to our second legendary investor. It's David Swensen. David Swensen is the investment manager of the Yale Endowment Fund, the money that belongs to the University of Yale. And over the last years, he made an average net return of 11.3%. So a lot higher. So let's look at what he's doing. So the first 10% of his portfolio, they are cash and fixed income. And fixed income is another word for bonds. Very standard. The next, about 15%, that's domestic and foreign equity. In other words, stocks from the US and from other countries. Then he has something that is called absolute return. That's this green part, and that's a pretty large part of his portfolio, probably 20%. And absolute return, well, that's finance term for I don't want you to know what I'm doing with this money. Later in the course, we're going to get to some of the advanced strategies that he's using, but you need to give me a bit of time for that. Then we have real estate, very standard, a productive asset. Then we have natural resources. That could be, for instance, gold. And from that, you see that he probably has significant risk in his portfolio, because otherwise he wouldn't hold that natural resources. What he wants to do is, because he has that significant risk, he has to mitigate that risk with non-productive assets. So that's why they are in there. And in the end, you see leveraged buyouts and venture capital. Those are basically equity, very risky equity investments. So you already see David Swensen, he does a lot of fancy stuff. He does a lot of risky stuff, but that's why he gets a higher return. And why can he do that? Well, Nikolai Tangen has to be a lot more conservative than David Swensen, because Nikolai Tangen, well, he manages the money of a country. You cannot get more conservative than that. And that is why Nikolai Tangen, basic, plain vanilla, very risk-averse investor with an average net return of 5.7%. And then you have David Swensen, very advanced investor, very high return, but also higher levels of risk. And with that, you've understood what financial products are out there in this world. Now, I want to talk about one of the most important players in the financial market, banks. So I will see you in the next video.